The information in this video is current on the day of recording. It is general advice only and does not take a personal situation into account. It may not be suitable for you.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today is John Addis. G'day, John.
Morning, Gaurav.
Looking very nice where you are. See you in Melbourne at the moment, aren't you?
You haven't seen my bottom half.
I never want to see your bottom half. That's let's hope that sentence is always stays true. Now we've also got Nick. G'day, Nick. Welcome. I think this is only your second, maybe your third podcast, and certainly your first using the video. So welcome aboard.
Thanks, guys. Thanks for having me.
Gents, I thought
also wants to make clear that that is not a fridge in the background of Nick's. It's not a beer fridge, right?
It's a cabinet.
It's a filing cabinet.
It does look a lot like a fridge, though.
A beer fridge, yeah.
A beer fridge. That's what I suspect.
Yeah.
I didn't want to say it, but that's what we all suspected.
He's getting ready for the Denmark game tomorrow, I think.
Perks of working from home.
Taking over all our meetings now. I know nothing about that sport. I have zero interest in that game. I don't get it. John, everyone falls over all the time and pretends they're injured. It's it's an embarrassing game to watch. I don't even like watching with my son because it's like, oh, why did they fall? Why did they fall?
This wasn't on the running order. I don't remember agreeing to discuss this.
Yeah, to bashing
you're
of the world game.
You're right.
Yeah.
That's why they're adding sort of 10 or 15 minutes to injury time because of all the time wasting that goes on with people rolling around on the floor. Doesn't seem to be working at the moment, though.
No, it's worse than ever. But listen. Let's move to another disaster that's probably worse than ever, and that is crypto. John, we don't talk about it very much in public, but privately, I think we've all been.
There's a reason for that.
Well, yeah, I mean, we've all been scathing about it privately, and I think somewhat. I think bamboozled by it is probably the right word. You've probably done more work than anyone in the team on crypto. What's your reaction?
Which isn't saying much.
That's probably true, actually. Yeah. What's your reaction now?
In total, we've written one story on crypto since this whole bubble blew up. Inflated and then blew up. And that was really just to explain the technology behind it.
Yeah.
I drew a parallel with the dot-com bubble. In retrospect, I think that this was probably a more obvious bubble than the dot-com bubble in our view, and that's why we didn't write about it, because it did seem so obvious and it did seem a great way to lose a lot of money.
Despite the very many requests we got.
We got loads of requests for it, absolutely loads. And you can see why, because lots of people were making a lot of money during that time. The story that I wrote was a result of me interviewing the son of a friend of mine who was, at the time, I think he was 20, and he had over 400 grand in the bank, which he'd made on crypto, and was absolutely adamant that he wasn't really going to take any off the table. He was in and all the way. And his cohort of friends, which some of my sons were in the same cohort, they all started trading the same thing. It just seemed to me like the most obvious bubble. I think the parallel with the dot-com bubble is correct in terms of the market psychology. I'm just not sure that the technology itself is as useful as what I first thought. And the ASX experience with their chest replacement suggests that, maybe the real world uses aren't as great as we thought. Whereas in the dot-com bubble, the real world uses were fairly obvious. It was obvious, I think, at the time that the internet was going to be a big thing. Whether crypto is going to be a big thing in the future, I still doubt, to be honest.
Let's just there's a lot to unpack there. Let's just stick with that comparison between crypto and the 99.com bubble. I actually think that understates the extent of the crypto bubble. The comparison I would use is with some of these historic bubbles that we all have read
biggest
about.
Bubble since tulips.
Yeah, tulips. All these manias that people write books about. I think crypto deserves a chapter in one of those books. I think this is going to go down as one of the most stunning manias and widely accepted, deeply held manias of the last 100 years. It's incredible. I'm really proud that we had the sense and maybe the foolishness to avoid it and to see it for what it was. And for me, that really comes down to reading a lot and recognizing what a mania looks like. And books like Tulip Mania and Panics, Crashes, and what's that called?
Yeah,
Manias, Panics, and Crashes, I think it's called. But those
crowds, is it?
The Madness of Crowds. If you have some sort of understanding of what's come before it, I think you just make yourself less susceptible to future mania. So this whole episode for me is an advertisement for wide reading. There's just it teaches you so much, and I'm pleased because I'm quite susceptible to manias. I mean, I 15 years ago, I'm convinced I would have been in crypto. I'm convinced of it, and it was because of financial education reading that. What we saw this. We all saw this very early for what it was. Nick, can I get a quick reaction from you before John deep dives into why the tech is crap?
Yeah, for me, it just seems like it's just been an awful lot of garbage from the start, but also just so many different fraudulent things along the way, and everyone sort of dismisses that as, oh, that's just someone else. And then there's another big one with FTX. There was a quote a few years ago when Bitcoin was really starting to take off, and there's a person on the news saying they were a trillionaire because they created a coin that had 1 trillion coins and they sold one to their friend for $1. And I think that sort of sums it all up for me. It's just,
That wasn't FTX, was it?
No, it wasn't. It was someone else.
Yeah.
So if the actual, I mean, I think we all agree, and I think most sensible people with an idea of history would agree that the coins themselves are a part of a mania. John, you've been more open-minded about the underlying technology. Has all this episode changed the way you're thinking about that? You sort of hinted that perhaps it has.
Yeah, maybe. The idea is that, and this is why I think it attracted so many libertarians and so many people who were kind of early 20s, young males who were kind of disenchanted with their financial prospects for their 20s and 30s. And the idea that you could have this kind of libertarian free range system where trust was not delivered by an independent third party, but was delivered systemically through clever programming, really. And instead of having one source of truth, you have multiple sources of truth, and you use those multiple sources of truth to verify transactions. It's quite an appealing idea to people who feel as though the system has failed them. I'm just not sure that that has real world commercial applications that are even widespread. There probably are some use cases. I think Dubai's got its land registry on a blockchain. Maybe the Ethereum network, which seems to be quite useful with smart contracts. Maybe that's got some commercial applications. It just doesn't seem that obvious to me. And there are obviously problems with the energy consumption, like it's hugely energy intensive. And I think Ethereum have tried to work on that. So they're doing proof of, instead of doing proof of work, they're doing proof of something else. I can't remember what the term is, but it's 90% less energy intensive. But even so, it seems like a lot of work just to avoid a central source of truth, when central sources of truth have worked out quite well for society over the past few hundred years. They served us pretty well. They fail every now and again, like all human systems fail, but generally they've done a pretty good job. And I don't really see the need to sort of abandon those sources of truth. So, yeah, I doubt whether this technology is going to change the world in the way that the internet has changed the world. Maybe it will, but it seems a question that's open to doubt right now.
I suppose we're about to see how much of the enthusiasm for crypto was built on the underlying technology and how much of it was more of a traditional financial bubble. It's easy to be enthused when the coins are going up and you've made thousands, hundreds of thousands, millions of dollars. Then it's easy to say that the tech is valuable, but this is the real test. I think we're about to find out, John. And I think it's right to raise questions and be more skeptical now, but we're about to find out if there is a real use case for these technologies, which sound interesting, but like you, they're just beyond me. I don't quite get it, and I don't quite see the use case for it, although plenty of people do. Nick,
Well,
where do you sit on that? Sorry, John, go ahead. You finish up.
Well, just if you take, say, the original use case of Bitcoin is kind of a gold replacement, limited supply, a store of value, that all makes a lot of sense. But that hasn't worked in Bitcoin's case. It hasn't worked. That's was a really good use case, I thought, for crypto, and it doesn't seem to have worked. In this environment, that should be going up.
Yeah.
But it's not.
And it's not
whether
just
that emerges.
A store of value needs to be stable as well.
Stable.
And the wild volatility of the price, just I think it renders it useless.
It does. And even the stable coins, which, has clever math behind them, they have failed. And I think the big tell in all of this is that some of the big crypto players who are still in there are now calling for regulation.
Yes, that's right.
So the whole point of this was not to have regulators involved. If we need regulators to make this work, why don't we just stick with the system that we've got?
My thoughts exactly. Yeah. Nick, anything to add?
No, just that, a few of the large banks overseas and the ASX has just blown up $250 million, I think, trying to do a similar technology as John alluded to. But there are players trying to do stuff with this technology. So there might be something there. But as you said, as a medium of exchange, it's hard to see that you're going to go down and buy a coffee with Bitcoin.
Yeah. I guess Bitcoin has also been linked to other boom time behaviors that we've seen over the last 10 years or so. And John, among those is another one of your favorites, and I think something that interests all of us is the levitation of Tesla. That share price.
Levitation.
that share price seems to defy all logic, and most people are surprised by where it has gotten and where it stayed. Do you see it that way as well? Is Tesla the next domino to fall in the crash of 2022, or is there something different about Tesla that stands it apart?
I think Tesla's different. Yeah. I'm not suggesting that we should all rush out and buy. I really don't think that. We've got part 2 of that story coming out on Friday. But if I can why don't I make the bull case for Tesla, and then you guys can have a crack at it.
We like destroying stuff, so Nick, that would be perfect.
That's right. No, you're both very good at pulling apart ideas. So the bull case of Tesla is that the mission statement that Musk came out with when he started Tesla was that he wanted to radically transform the switch to renewable energy vehicles and transportation. So that's predicated on becoming a big manufacturer. And key to that was, it's an Apple kind of argument, which is the integration of hardware and software, which fundamentally delivers a much better user experience. So I think that's the first point to understand, is that I would think about Tesla in that way, as the integration of hardware and software. Traditional automobile car manufacturers have just been terrible at software, absolutely appalling. And Tesla seems to have got that right. And that gives it some distinct advantages in terms of self-driving and efficiency and user experience. So I think that is something that they have established a lead in. The second point to understand is that car manufacturing has traditionally been a horizontally integrated industry. So each part of the way, from equipment suppliers to car makers to logistics companies to dealerships, everybody takes their cut along the way. Tesla's kind of inverted that and established a vertical integration model, which allows it to deliver what seem to be industry-leading profit margins. So Tesla's now making more money than, per vehicle than some of the elite manufacturers like BMW and Mercedes. They're really doing a very, very good job of that. They produced 300,000 vehicles last quarter. So they've made that big jump from 0 to 1 million vehicles a year. I would suggest that is a harder thing to do than to go from 1 to 5 million a year. Toyota, for example, makes about 8 million vehicles a year. So if Tesla is to make that transition, accelerate the transition to EVs, it's going to need to produce 5-6 million vehicles a year. To me, they look likely as though they could actually do that. They've integrated the supply chain as well. They've secured battery resources. They've established a great global brand. And the thing is trading, I think, on a PER of around 70 now, which is half what it was. So if you can go from 1 million vehicles a year to 2 or 3 million vehicles a year and maintain those margins that they're currently making, and theoretically they should actually increase as scale increases because there's massive economies of scale in car making, that PER could come down very, very quickly. So that I think is the bull case for Tesla.
Nick, I'll let you go first. Where do you see holes in that argument, or are there any, or do you agree?
I'm just going to leave now and come back in about 20 minutes, all right?
Well, I might start with governance. I think part of the bull case is Elon Musk and how much he's a visionary leader, and he's done amazing already, as John described, upending the car industry. But there's another side of that too. And I mean, this is a company that has been fined $20 million from the SEC for faking a takeover offer on Twitter. It's a company. It's a company who renamed their CFO the Master of Coin. I
tell you what, he's got a good sense of humor, though, Elon, doesn't he?
He does.
I appreciate that about him. He's a funny guy.
Yeah.
He does. The other one too is they earn, I think John alluded to it, they earn, I think, close to 30% gross margins on their vehicles. And that's much higher than any other car company. I think double some other car companies, or even triple.
Yeah, it is.
Triple. Yeah.
And that's because they own a lot of that supply chain. But if someone came in and really tried to have a go at it, maybe it's too far gone now, but it's always been a capital-intensive industry, and it's still that for Tesla. They have to spend billions of dollars rolling out these, I think they call them gigafactories, or these large factories where they produce tens of thousands of vehicles. So if you look at the history of some of the biggest businesses at the moment, like the Googles and Microsofts of the world, they're typically capital-light businesses. Capital-intense businesses are pretty hard. And people usually come back in. Whether that continues, it's hard to know. The other one risk is 25% of the sales come from China, and a lot of the manufacturing comes from China now. I think about a third of the manufacturing. So there is that US-China risk because it is still a US company.
It's interesting though, right? So we're not talking about a big blow up. We're talking about very traditional, conventional operating risks that apply to, I'd say, almost any car maker. But it's a different argument now than what it was, say, 5 years ago, where I think myself included would have argued that Tesla was a time bomb waiting to go off, and that really hasn't been the case. And I think what everyone has missed is just how different and unique EV design and manufacture is to traditional design manufacture. You know, as a car guy, I actually I'm not a fan of EVs. I don't like them. I don't like driving them. I am incredibly skeptical about the environmental benefit. Not just skeptical. I think it's actually, everyone's got this wrong. No one quite appreciates how mineral intensive the batteries are. They only last for a short time, and you have to replace the whole thing all over again. The ability to recycle those minerals is really difficult. And it's not clear that we have the sheer resources to convert the entire global fleet over. And then at the end of the day, after you finish driving in your boring, silent, soulless car, you go plug it into the power grid where fossil fuels recharge it. It doesn't work. I don't understand why we think this is the salvation for climate change. And if the problem you're confronting is there is too much pollution, there are too much carbon emissions, the stupidest idea I can think of is let's just replace emissions at the tailpipe with emissions at the generator side and put a mineral intensive, energy intensive battery in the place of a mechanical engine. It makes no sense. Why not make the cars smaller, lighter, and more efficient?
Well,
why not
true.
work on the generation side rather than cleaning up the generation rather than cleaning up the engine? We're solving the wrong problem, but that being said,
let me take that on.
Yeah, go on, John.
Okay, so there's two things I think you raised. Firstly, Nick's point about China is absolutely correct.
Yeah.
Tesla could be really wrapped up in a trade war in the same way that Apple can be.
Yeah.
And that could completely stuff the growth prospects of that company. So I think we have to accept that as a risk. Just in terms of the governance issues, which is basically a nice way of saying that Elon's a nutter. I would say that is a feature, not a bug. And and I think you have to be kind of mad to think that you can do the kind of things that he's done. Like the idea of building a rocket that goes up into the outer atmosphere and then comes back down and lands in one piece.
That is genuinely extraordinary. Yeah.
That is an astonishing thing to think that he could solve, or he could build a business that solves that problem. So I think people are getting way too carried away with all this Twitter stuff. Twitter is quantifiably different in terms of programming, in terms of engineering problems. It's really not an issue at all. Twitter's problem is its users and how those users collaborate and interact on Twitter. It's an entirely different problem to what Telstra is trying to solve. It's an entirely different problem to SpaceX. So I don't think Musk is at all suited to solving the problems at Twitter, but I think he is suited to solving engineering-based problems at SpaceX and Tesla. And you can look at all of his stuff about the kitchen sink and, putting Trump back on and all of that kind of stuff. But I don't think that's the issue. I think that those two businesses that he's already established and Solar City has shown that once he's established the principles, he does actually build a workforce that is quite loyal and wants to solve those problems and will do almost anything to work on those things because they are so interesting to them. And they're prepared to forgive him all of his sort of personality traits that might otherwise wind people up. It was the same at Apple with Steve Jobs, who was also kind of weird. Like, he spent 6 weeks eating carrots and his skin went orange. These tend not to be normal kind of people. They are on the edge, and that's why they do this interesting stuff. So I'm prepared to give him not a pass, because some of the stuff he does is quite mad, but I would, if you're thinking about investing in Tesla, which I'm not, I would separate Musk and the reporting and the stuff that he's getting involved in Twitter from the other businesses that he's doing, because he's built a new car industry and is producing now 1 million vehicles a year from nothing. So that's the governance issues. Yeah, there's a problem with them, but I think that's part and parcel of the problems he's trying to solve. Now, in terms of your point, Gaurav, about this being the wrong way to solve emissions, there's obviously a lot of truth to that. There's no point plugging, well, there is a point, but it's not as good to have an electric vehicle and plug it into a coal-fired power station effectively. But all the machinery is there for users not to have to do that. And I never thought I'd be on a podcast where I would talk about my brother, who once flew to Stockholm to look at a set of taps. But he is absolutely obsessive about being emissions free. He lives in the UK, he's got a load of solar panels on his roof, and he's got 2 electric vehicles. And he now thinks with 3 more panels, he can be completely off grid, having done what we call the thermal upgrade on the house with a battery, with 2 electric cars and all these solar panels. Now, you can buy all of that stuff from Tesla. They're setting up in a way where you can effectively go off grid and not use any power from the electricity network at all, just with batteries and panels. And my brother's proof that you can do that now. It's not cheap to do, but the people who are buying Tesla cars are probably the audience that can do it if they want to. So I think this is a proof of concept thing. And we're not saying that, nobody's saying that Musk on his own is going to solve this. Nobody on their own is going to solve this issue. But the faster we get to a point where there are more electric vehicles on the road, the more likely we are to build an electricity network that is cleaner, far cleaner than what it is now, I think. Because once you get an electric car, if you're buying it for environmental reasons, you don't want to be using coal-fired power. You want other sources. So I think it creates its own demand to help with that transition.
Toyota, of course, has a large EV program, but they've actually been working on hydrogen cars for about 20 years.
They just
And
released the first one, haven't they?
yeah, the Mirai, and apparently, I mean, it gets reasonable reviews. It's a completely different approach to solving that problem, and I guess we haven't really seen the traditional competition. Generally, you get a new industry and the incumbents fight, and there's new entrants who are fighting. We haven't really seen an effective tussle in EVs. The traditional car makers, they're not going to be there. It's not them. Because they can't get their head around the complete difference in design and manufacture when it comes to EVs and engine cars. I've seen most designs for EVs, they just take their traditional platforms and instead of putting an engine in, they put a battery under the hood, which is just pretty silly, really. It's a silly way to do it. And even
isn't VW now building its own?
Yeah. So even now, when take VW for example, so they've stopped doing that, and they've now got specifically designed platforms for EVs, which do some of the stuff that Teslas have been doing for sort of 10 years. But even then, they outsource somewhere between 80 and 40% of their software to third parties. So they're not really doing the software integration. All the traditional auto companies are trying to hire developers and do the software thing, but they're not doing it to the extent that Tesla has done it from the beginning, and it's not clear that they're doing it very effectively. We're just starting to see the emergence of true Tesla competitors. You know, companies like Lucid, who start from the very beginning as an EV business and have fully integrated software and hardware. Those products are amazing, and we'll have to wait for them to sort of challenge Tesla to see how durable that business really is. But look, I'm actually really impressed with Tesla as well. I'm not going to poke too many holes in it. I think how they've mastered the economics has been amazing, and they've just been really good at recognizing how to take advantage of a completely new technology in a way that the traditional car makers have completely missed.
So this is all the existing car manufacturers face now what Clay Christensen called the innovator's dilemma.
The innovator's dilemma, that's it.
Yeah. So they have to re-engineer their entire thought processes and approach to making cars that have served them well for 100 years. And in so doing, they have to sacrifice what they're currently making from their current vehicles in order to just take the risk of being a good competitor to Tesla and maybe some of the other EV companies. And there's so much sort of legacy thinking in these industries that I think that you're right. They're gonna struggle to do it well. But there's a kind of survival imperative, I think, down the track for them as well. Yeah,
it's an interesting case study. So go ahead.
What do you think the competitive response, Nick? Do you feel as though some of these companies are going to be able to make this transition? Like VW seems to be doing something, Hyundai seems to be making progress as well. They're all talking about EVs. Is that going to crunch Tesla's margins down the track, or do you think that maybe they've already secured their spot and now it's just a case of taking market share off everybody?
I mean, potentially, I think you've sort of alluded to it too, that Apple only sell, I think, 1 in 5 smartphones around the world, but they take, 95% industry profit. Yeah. So you can see maybe a similar situation like that taking place. And some of Tesla's margins are their own doing. Like, for all Elon Musk's governance and bravado, there's a reason they spend no sales and marketing dollars, because, he's always in the news, trying to save, boys in a cave in Thailand from his living room.
And calling the people who actually do it pedophiles.
Yeah, exactly. So compared to other car companies that have billions of dollars in sales and marketing budgets, Tesla has nothing, which is quite remarkable that they've been able to do that. But yeah, I think one of the biggest threats, and this is longer term, and whether we can do it is a huge question. But autonomous vehicles has it can really change the whole industry, where there is a world where we don't own cars anymore because cars are 95% idle. They just sit parked, and we don't need as many. And I think Tesla's obviously, touting its own autonomous vehicle technology, but there are other players in that as well. I think that's a legitimate threat further down the track. But in between, I think you're going to have this sort of electric vehicle transition, and it looks like they're by far and away ahead.
One other threat, though, that and you spoke of this, Gaurav, is that this is it's kind of like the aviation industry in those early days where you can see that this is going to be big, but you don't know in which direction it's going to travel. You're going to have single engine aircraft, you're going to have multiple engine aircraft, they're going to be biplanes and mono-winged. You don't really know. It's possible that Tesla is kind of too early. And this is where the difference with Apple is. The parallel kind of breaks down. Apple likes being second or third and watching everybody else stuff it up and then come in something that actually solves that problem. Tesla has been first, and that means they have to commit to technologies that might not be the ones that we really want long term. And hydrogen is a good example of that.
Even the very specific battery technologies. I mean, the chemistry is always changing and evolving, and it's not clear which battery chemistry is going to take the lead. But they've sunk capital in these gigafactories, and they're stuck. Like, if the battery chemistry evolves and gets better, they're stuck with the technology path they've gone down. Right. I think that's right. A risk for them as well.
Yeah.
But look,
in order to establish. Sorry,
go on, John. Go on.
Well, in order to make the future, you have to commit to some kind of technology. You have to commit. Otherwise, you're not going to be able to get to 1 million cars a year. But in so doing, because you're so early into it, it potentially closes off other avenues that might be more successful for the industry at large. Yeah. Let's close off Tesla, actually, at that point. We've had a big conversation. We better talk about some Aussie stocks. But John, looking forward to that part 2. That's coming out this week, is that right? So by the time Friday.
people hear this.
Yeah.
Okay.
Yeah.
All right. So it should be up by Friday. Nice one. Okay. Nick, let's go to you for a moment. You've picked up some of the businesses on the ASX. As the last one through the door at II, you've been stuck with the companies that are too complicated or too hard or too uninteresting.
Expensive.
Or too expensive for the rest of us to take a look at. But that's actually saddled you with some really interesting stocks, and you've started writing them up. I was particularly interested in Goodman Group, which is the company that I feel as though we have missed over the years. It's been
I think that's understating it.
It is. I'm trying to be understated here, John. Not only has it done really well in terms of share price, but the way that business has been built out, the way it's run, the way it dominates its niche, certainly in Australia, it has all the hallmarks of a business that we generally like to get to know and we want to invest in. After taking a close look at it, do you agree? Is this the sort of business that we want to take a more active interest in?
Yeah, absolutely. So we've kicked it off with a hold recommendation. I think the business quality is almost unquestionable. They've done a really good job out of the GFC where they almost did go broke. They've reduced debt on the balance sheet and really transitioned the model to less of a real estate investment trust and more towards a global fund manager or even private equity-like business focusing on industrial property.
Let's just break down the business model, because I think this is quite unique and confusing. It's classified as a REIT, but as you say, it's not really a REIT. It's more of a fund manager. Just explain to us how a REIT morphs into a fund manager. What are these activities that Goodman does, and how does it make so much money?
Yeah, so there's 3 prongs to the model. So there's rental income, which is this your traditional real estate investment trust, earning money from properties, earning rent from tenants. Then there's fund management and development, and they're sort of in the same boat together. And so what Goodman does is they'll put up typically 1/5 of the capital and go to big overseas, generally pension funds like the Canadian Pension Board. There's a Chinese pension fund as well involved. and create these partnerships in each geography and go and buy logistics properties or industrial properties. And then they'll charge the partnership management fee, the same as a Magellan would earn a management fee. They'll charge the partnership performance fees on any outperformance above agreed upon benchmark, which are mainly kept private. For example, the New Zealand partnership is the only one that's listed. So their hurdle rate or their performance fee that they've got to beat is the New Zealand REIT index, essentially, or property index. And then they'll go and use the capital that partners provide to not only buy properties, but buy land and develop it, or they'll dispose of assets. It's this entire model around industrial property, and they sort of take a clip in every little corner. So if they're developing a project, they'll charge the partnership a project management fee. They'll take a fee on any excess returns they might earn. So there's very similar to Macquarie, there's just fees on fees on fees throughout these partnerships. And there's been a huge desire for the capital to find more investment in property over the last, I guess, decade, with interest rates going so low that the Canadian pension funds got to meet requirements, and they've got to find returns somewhere. And industrial property's been a huge winner, as is all property, but where Goodman focuses a lot is industrial. It's almost entirely industrial. So compared to office and retail, which has maybe suffered over the last, particularly since COVID, industrial has taken off because the demand's mainly coming from e-commerce players that need to be in sort of consumer-centric locations in major cities close to the consumer.
One thing I've never really got my head around, Nick, is just the extent of the fees. And you mentioned Macquarie, and I'd say that's another business that's always surprised me, just how much fees they can extract from a deal. Is that, it has been sustainable for Macquarie. Is it sustainable for Goodman? Do you think their partners are always going to be willing to pay those fees because the developments are that profitable?
Well, I think that's it. I mean, these partnerships have been earning 15 to 20% returns. Now,
really?
Yeah, and for a number of years. So at the moment, they are happy to pay it. But it's one thing, I think we mentioned the article too, that can turn, particularly in a recession like it did in the GFC, is that development profits can really fall because they just don't complete as much work. They don't start any new projects, so the work in progress falls. And developments now make up 50% of the profits. So that's probably why we're not a buy on the stock, is because that number can really fall if things get tight.
John, did you want to say something?
I've got a question about, I don't know much about Goodman, but it just seems to be extraordinary the amount of money it can make for what it really does. Is it that hard to build big boxes? Where's the skill in that?
There's a little bit of skill.
Or is it all just financial engineering?
Oh, there is some financial engineering as well. Two of the things Goodman have that I guess a lot of other managers around the world don't have is, one, they have a global presence. So a lot of the competitors are more local. Even Prologis in the US is mainly a US business with partnerships in the US. They do have some outside, but Goodman are one of the only companies that actually specialize in industrial property and have done for 2 decades in almost every continent on earth apart from Africa. And so the feature to these big pension funds is they can go to just one manager and get global exposure. The second feature, again, it's not that no one else can do this, but they've been really good at designing properties. So I think in the article we had the Interlink property in Hong Kong, which is 24 stories, 15 stories is accessible by trucks. And it's not that no one else can do this, but they seem to be actually a bit of IP in that design work. And they've also been ahead of the game in providing or developing environmentally friendly buildings. And buildings are one of the main contributors to emissions. So tenants like Amazon, which is I think 8% of income, really want that because they've got their own ESG aims that they need to hit, or they've mentioned them in their annual reports before, net zero by a certain year, and their building footprints are a big part of that. So they're probably the two things I'd say that Goodman has done better than the competition, but it's not that no one else can do this. They've just been the best. And then the other one is just the returns, which have just been outstanding. So there's no really reason to leave at the moment.
It reminds me a little bit, I guess, of Westfield, in the sense that anyone can build a shopping centre. It's not impossible, but they did it a little bit better. And because they did it a little bit better, the rewards they got were a lot better. And I think that's true in this industry as well. A little bit of improvement can lead to drastically outscaled outperformance as well. I'm familiar with Goodman because they're a joint venture partner for a business I cover, Brickworks, and Brickworks management is constantly singing the praises of Goodman, saying that the location of the properties is really important, because when you have essentially a logistics warehouse, it has to straddle main roads. It has to be close to customers. Being close to port and rail is also really important as well. And there's only a limited supply of that sort of property. And once you build up a handful of warehouses, all the trucks and all the logistics already lead to that area. So you end up sort of creating your own network. And I think being early and locking up a lot of good property and owning those networks already is a huge advantage for Goodman. It makes it much harder for someone else to come in and try and compete.
Yeah, that's I guess that's all correct. The other one I would say, probably going back to the previous question, is they also have long dated capital, which is a real difference compared to Magellan, let's say. So the Canadian, because it's property and it's a liquid, let's say the Canadian Pension Board, they can't just sell all their stakes tomorrow. This is locked in for several years. And so essentially by locking in these partners, the assets grow, they just build, and they've got pre-commitments, just like private equity has pre-commitments from capital partners. So they have a contract that they need to contribute X, Y, Z each year. And that sort of this continues to grow. And then over time, particularly where interest rates fall, valuations go up. So it's like just feeds into this whole model, and then they allocate more money because that's where the returns are. And that's pretty much what's happened since the GFC. And they have had, as you say, they have had a lot of these properties in the best locations. They've also de-risked the balance sheet by selling all the worst properties. All the worst properties they held on their balance sheet, they've just got rid of, and really focusing on just the properties with the best logistics networks and the best access to roads, ports, infrastructure, as you said.
There was
sorry, go on, Joe. You go first.
There was a friend of mine who works in industrial property saying that that your point about the locations that Goodman has got is pretty accurate, and that a lot of the increase in the cap rate and that effect on valuation is being offset by rental growth, because they do own all of the best, not all of them, but the best properties. And if you're looking at land that is close to the customer, you're normally looking at inner city land normally, or land that's in short supply. And a lot of that has already gone in many of the major cities, and you end up building 16-story warehouses in Hong Kong. And there's only so many of those that you can do. So they do seem to have carved out a niche for themselves where these high value urban locations are really desired by tenants.
Just to play devil's advocate for a second, I mean, we're all, the three of us, I think, are in agreement that this is a high quality business. It's one we're interested in. But another way of approaching Goodman is to consider that a lot of its success came post the GFC in an environment where interest rates have collapsed. They've been zero for 10 years, unprecedented. And in that environment, if a property business can't make bucket loads of money, especially one with huge development profits, there's something wrong. So, I think we ought to be a bit more cautious, or we can be. It's an argument to be a bit more cautious in a rising rate environment where that development pool is potentially smaller or less profitable, and the business gets tested in a way it really hasn't been tested over the last 10 or even 15 years. Nick, is that probably a bit harsh?
No, I think that's 100% right. I mean, if you look at it compared to just a typical real estate investment trust, the valuations that come through, or the revaluations that have come through, are just an accounting sort of metric. It doesn't really matter. It doesn't come through in cash flow. But this is different with Goodman. So when a partnership revalues a property, they charge an asset management fee of about 75 basis points based on that revalued value. So if it goes down, if it goes the other way, then the assets under management falls and the actual earnings for Goodman fall as well, the actual cash earnings. And the same with the development business. So over the last 10 years, or since 2011, they started with 12 billion assets under management. It's now, I think it's close to 80 billion. But if you just take the 70 billion that they had under management at the end of last financial year, about half of that gain, or a little bit over half that gain, has come from revaluation property. So, which is capitalisation rates falling from anywhere from 9% to 4% what they are today. So a lot of Goodman's gains have come from the revaluation of property and the earnings that have flowed through. And then on top of that, they've just been in the best area of property, which has been industrial property, because e-commerce has taken off over the last decade. So they've definitely benefited. And importantly, the income statement and cash flow statement, as well as the balance sheets, benefited. It's not just a revaluation like a typical real estate investment trust. I think you've talked about it before with Brickworks, that they say, those profits may reverse at some stage.
Yeah, completely different. That's probably the single most important point to understand about the business. And you're right, Brickworks is a great example, because the management, who I really rate at Brickworks, they have all the way throughout the boom, they gave warning that, look, we got these revaluations coming through. They're not real profits. We don't count them as real profits. And they said that as the asset prices were rising. And they're saying the same things now as our asset prices are falling. They're saying that, look, those weren't real profits. They didn't benefit us, and so they're not going to hurt us on the way down. And I completely agree with that. I think that's true. That's accounting treatment affecting the bottom line. But your points were made. Goodman is completely different. You've actually got real cash flows coming from that accounting treatment. So things are going to get really nasty if they can't compensate for that lack of that falling FUM. If they can't do something to offset that, then profits are going to fall.
John's point about his made in industrial property is absolutely correct as well. Even though most people expect capitalisation rates to rise, so from 4% to maybe 5 or 6, rental growth in their properties is offsetting a lot of that valuation fall. Right. Okay. So some of their properties in the US, Goodman have said they're 40% under rented, or they can increase rents about 40%. The two main inputs in valuation for them are the actual capitalisation rate and the rental levels. So there should be some offset, even if capitalisation rates do fall, or rise, I should say.
That's why it's so hard.
This. Yeah,
I mean, the valuation is so difficult, and the reason I think we haven't upgraded, I don't think anyone on the team actually owns Goodman, is because you have these two very powerful forces working in opposing directions, and we don't really know which way this is going to land. It could be potentially very bad, or it could be quite favorable. So yeah, it's just hard.
What's a disaster scenario for this business, Nick?
I think the disaster scenario is legitimately what happened in the GFC. You come in over-leveraged into a massive property bubble, and they had the issue of 1-for-1 rights issue at 40 cents to save the business. The stock absolutely collapsed. I think it fell 95% plus. That's the disaster scenario. I think in this case, unless we get some, extremely high interest rate, which there'll be many disasters in that case, that's off the table this time, just because the balance sheet's been repaired. It used to be about 50% debt to equity. It's now 8%. If you include the partnership, the partnership stakes, it's about 19%. So it's just a different ball game in terms of how leveraged they are. The probably the worst scenario I can envision is just those development profits really fall, and then some of the valuation. So I think the rental side of the business, they've got 99% occupancy. The rental side of the business, which is about 25% of earnings, should continue to grow earnings. I mean, I don't think Amazon's pulling out of any warehouses they've got just yet, and most of the other customers are big, like Australia Post, like industrial businesses or logistics businesses. So yeah, it'll be this on the development side of earnings and potentially the assets under management or the FUM side of earnings as well.
The fact that there's a founder there just provides so much comfort, doesn't it? And a founder that's actually shown himself to be quite sensible.
Yeah, absolutely. And it's not just the founder. So the founder owns, Greg Goodman, he owns, I think, a stake worth about $800 million, but all the major, all the senior executives own stock. They've all been there. I think the 6 people they have in their key management personnel report in the annual report, they've been there for 10 or 15 years plus, all of them. The business had 6% employee turnover last year, which is extraordinarily low. So I think it's a culture that he's built from the top, and it goes all the way through, and most people own shares in the business that work for them.
Nick, I've got an uncomfortable question for you. So we clearly missed this. But why do you think we missed it?
That is an uncomfortable question. I think Nathan was the analyst for most of it.
Yeah, he was. But I just wonder whether, because of the experience that we collectively went through Goodman with, stopped us from seeing what it became after that catastrophic event.
Yeah. I think that's part of it for sure. I think the other thing to really envision back then what Goodman is today, you would have had to predict that e-commerce was going to be as big as it is today, which a lot of people didn't. I mean, we take it for granted how big Amazon is or something like that today, but a lot of people didn't predict that in maybe 2010, 2011. But the other thing you had to predict was that capitalization rates were going to fall from 9% to 4%, and interest rates were going to be zero. Like at a central bank level. So all those things have helped not only property companies, but in particular Goodman Group, because of the things we spoke about before of the revaluations and that sort of thing. So I think it was pretty hard to see. Maybe the thing was just to back Greg Goodman, and that they still kept a lot of the partnership assets under management. The tenants, the actual occupancy of the buildings never, I think, fell below 94 or 93%. So the buildings were occupied. So there was a legit business underneath, but there was risk back then too that they need to deleverage the balance sheet. And I guess they did quite aggressively.
I think you're being quite kind there, Nick. I think we're all aware that the shopping thing was taken off, and I think John's point is quite right. I mean, we saw this thing go almost bust, and to back it after watching it fall 95% is really hard. I actually had a similar experience with Linus. Linus, the rare earth miner, used to be a basket case, an absolute basket case. Were poorly managed, and they couldn't get the chemistry right. And I saw that thing struggle and almost go under multiple times. And when new management came in and sorted that business out, I was very late to see it, because I was scarred by what I'd seen about the business earlier. It just leaves you with this lingering skepticism. And, I don't think anyone minds being wrong in this industry. I mean, we're all wrong sometimes. It doesn't bother me one bit. But to be wrong on the same stock, that would hurt. And I think we're trying to avoid that a lot.
Wrong on the same stock twice.
Yeah. You don't want that.
That's hard. It's funny, isn't it? Because there's this argument for experience, which I fully support. But there is a way that experience also takes your view, the way that history forces you to see things in a particular way, or suggests that you see things in a particular way when the future might look very different from the past. It's just hard to see.
No, completely agree. Hey, listen, we better move on from this and quickly finish up on our last segment, which actually just wanted to have a quick word about AGMs, which For the first time, I've been attending more regularly this year. Made a huge effort to get to a lot of AGMs, or at least listen to them and read the transcripts after the fact.
I thought you put on a bit of weight.
All those sandwiches. It is tempting. Well, it's actually great. I used to think, oh, what a waste, all these sandwiches and just go for the food. But you're sitting there for an hour and a half or 2 hours. The sandwiches are just a delight when they come out afterwards. It's so nice.
Yeah.
And some companies bring out some really good stuff. New Hope, which I expected to be really stingy and bring out nothing and maybe a bit of chips. I mean, I actually bought my lunch beforehand because I was like, I was telling the guys that New Hope's not going to provide any lunch. It's not going to give you anything to eat. This is the Milners. Come on. And they put on a fantastic
their food
spread.
and beverage budget must be pretty awesome nowadays.
Yes, that's right. They had a great spread and it was very good. But look, my point is really, I wanted to get your ideas about this as well. I credit my friend Greg Hoffman for getting me to more AGMs. He's been saying for quite some time that if you go to one, you might not get that much out of it. But if you start going to several, you start recognizing things and you start seeing things that you don't always get to see. And it's the only time we get unguarded access to management. When you ring up management as an analyst and you want to have a chat, I find that completely useless because they're on script and they don't help you out. Yeah. But over a sandwich at an AGM when you're wearing jeans, that can be different. Is that your experience as well, John? Maybe you go first. Are you
there was one.
There
was the one that I remember from AGMs is it was actually Greg at Brambles, and Brambles had lost. I don't know how many pallets it was, but it was a lot and it impacted their results. And they were denying that they'd lost them. They said, we just don't know where they are, but they are somewhere, right? But they're not lost. And I think Greg went up and had a chat with the CEO or the chair at the time, he said, of course they're effing lost. So there was this public and personal persona that were quite different, and he just couldn't bring himself to come out and say what everybody knew because that wasn't the company line. So you do get instances like that. I think for me, and I was hoping to go to the Lovisa AGM last week, but I was bloody sick. But often you see the dynamic between the management teams in real life, how they interact, how often they interrupt each other, who uses I a lot. Do they talk in the we, the collective, or the singular? Is the CFO sitting there sort of cowering before the CEO, worried that he's going to say something out of place? All of that kind of stuff.
The relationship between the chairman and the management, the board and the management, you get to see that relationship, which is crucial, absolutely crucial.
That's right.
And that's the only time you'll see that. Yeah. Sorry, go on.
Well, it's just this is the soft side of analysis. In most cases, it's probably not that pertinent, but there are situations where, especially in growing businesses, where the management, I think, is really critical. They're not just sort of custodians of a monopoly asset. They're actually trying to build something. That dynamic between the various members of the management team is really, really important, and you only really get to see that face to face to AGM. So I think that in itself is a good reason to go.
Nick, what about you?
Yeah, I haven't been to a lot, but I think your point on finding them or getting management and the board when they're unguarded is it's extremely important. I mean, you can sit in front of your computer and read the transcripts from an AGM, but it's not the same as going and actually meeting these people face to face. And that dynamic between the board and management is another good point. I mean, how many boards have we seen over the years that just don't care? Like, you've seen it with AMP, and then you've seen, as you said, with like New Hope and all these companies. Levis is another good one, that the board actually cares. They're invested as well a lot of the time, particularly a lot of the time the chairman, and how they incentivize management is another big one, because a lot of the times the board really, I think, just doesn't care. They're just there to get a paycheck.
I think it's for me, what I realize, it's a good chance to understand the people running the business. And I'm not pretending I can read their body language or get to know them after a 30-minute chat, but you do pick up bits and pieces. So an example from from the New Hope meeting. We went over a group of friends, and I went over before to Muswellbrook. We're having dinner at the at a pub in Muswellbrook, and the entire New Hope executive team and a bunch of other people were at the pub, and they were having dinner as well. And so we were just kind of watching them.
Been for the last 3 days, probably.
It's a small town. We bumped into the same people so many times over the course of a couple of days. It was quite funny. A random lady just came up to me and said, "Geez, we're seeing you boys everywhere. Where are you going? Why are you following me around?" It's just a small place, and we're walking around, and we just keep on bumping into the same people. But what I noticed was that Milner, Rob Milner, his son, and the CEO and the CFO, and the 4 most senior people in that business were the last ones to leave that night when everyone else had gone. And those 4 individuals cleaned up after themselves. They brought all the plates and everything up, big armfuls of everything, and brought it to the counter and had a chat to the people who were at the pub. They clearly knew each other reasonably well. And, this is a billionaire, a bona fide billionaire, cleaning him up after himself and having a chat to the staff. It's probably not a big deal, but it tells you, the fact that he cleans up after himself makes me feel a bit better about him operating a mine and cleaning up after himself on the mine site.
What would that say about rehabilitation of their mine sites? Like, could you make the argument that their rehabilitation is better than anybody else's in the industry? It
is. Look, I think it's a long bow to link those two together, but it gives you an insight into kind of people who are running that business. And it's no coincidence, I would say, that your point is 100% correct. New Hope actually has maybe the best record of mine rehabilitation in all of Australian mining. They've rehabilitated several coal sites, and now they're actually operating farms on those sites, and they own cattle on the former mine site. And when you see pictures of it, I've never gone in person to see the rehabilitated site, something I want to do one day, but pictures of it, you would never know there was a mine there. It just looks just like a farm. And there are very few miners who leave the ground untouched the way New Hope do. And I don't think it's a coincidence that the sort of people who clean up after themselves and think of their own identity with humility, that do that in their professional life as well.
Yeah.
So there you go. Go to the AGM and get to the pub. I think that's the lesson from today's podcast.
That sounds like a full life to me.
That's the AGM and pub. It was the meaning of life right there. Listen, we better get some other stuff done as well. It was nice chatting to both of you. Nick, great to have you today. We're going to have to grab you on for some other stocks as well. So don't go too far. We'll see you soon. Thanks, Nick.
Thanks, guys. Thanks for having me.
And John, huge treat to have you. We don't get to speak to you often enough, but I'm really glad for your time today. Thanks.
No, it's good. I really enjoyed it, and enjoy the game tomorrow, Nick.
Oh yeah, thank you. Will do.
Soccer stuff. Goodness me. All right, for everyone else, despite the soccer, thanks for listening.
All right. See ya.